Yoav Sharon, portfolio manager at Driehaus. We've got him on the phone now to make sure we don't lose him. Yoav, thanks for coming back with us here. So you mentioned that today we're getting a similar response as we got with Pfizer. It's a little bit smaller, though, as the market comes to maybe grips that this is going to be a reality. How do we assess whether or not that means it's already priced in, or if maybe we just move a little bit more slowly but still do rotate?
Yeah, no, I think that's spot on. Obviously, last Monday's news had moves that were quite epic. I mean, going back decades in terms of factor volatility, in terms of momentum versus value. But what we're seeing today is obviously a much more muted reaction in the marketplace. And I think it's just a digestion period for investors, and investors and market participants are starting to realize that the vaccine obviously is wonderful news and will have implications, but it's not necessarily or potentially not going to cause some massive rotation within the marketplace.
So, Yoav, how do we know kind of when the quarantine froth has been shaken out, right? I mean, we saw such a explosive sell-off on the Pfizer news, and it seems like from that kind of perspective, if that kind of quake didn't break the market, 10% down, 20% down in some of the quarantine trades, is it because they're not big enough to bring the market down, or is this just getting started and they could slowly grind lower? I mean, I look at a stock like Peloton that's still up 5 times off its lows. The tech names on the big cap space also still up 40, 50% on the year. How do we know when we're out of the woods shaking off the quarantine valuations?
Yeah, no, that's a great question. I mean, I think what we're seeing is investors are getting more comfortable with not only those stocks and those epicenter stocks, but also the market more broadly. Obviously, we're trading at pretty healthy or even overextended valuations. But when the alternative is to invest in the 10-year at sub 1%, 90 basis points today, that's very difficult for investors to do. So, I think Q3 earnings have been very strong. They've been exceeding expectations. Obviously, expectations have moved all over the place this year, but the fact that investors in the equity markets are getting rewarded by earnings that are coming in stronger than feared and anticipated is that, coupled with the fact that there's essentially nowhere else to put their money. I think that's in large part a lot of what's moving the market. So
a lot of this is coming down to yields still on the 10-year, and in fact, what we've gotten throughout this crisis is a huge surge again in negative yielding debt. You've got a chart from your latest report, your chart compilation that you put together, and once again we're at the highs that we've seen here as central banks have been active. And what do we know, though, Yoav, when that curve starts to come down? Here's the negative yielding global bonds. We've been here before. We got here and then we slowly unwound it. What happens if we start to unwind that again, Yoav? If this was another kind of test for the market's appetite for negative yielding assets as we pumped all this money back in over the last 6 months. If we peaked here again on negative yielding bonds, what's that going to mean for the market as investors look to put that money to work?
Yeah, I mean, we have obviously a very long way to go before rates even normalize. If we go above 1%, that'd be just the first leg of potentially rates increasing. But we haven't really seen over the last decade, every time we think the rates are going to start re-rating or a reflation trade or an inflation trade coming, it's been either unwound or stopped in its tracks pretty quickly. So, we have a long way to go before yields have an impact probably on asset allocation and how investors consider their portfolios. That said, any sort of unwind of that would have large implications. I think it's too early to tell or too early to say that it's occurring. We are seeing, even last week we saw some inflation data that was quite muted. So there's still plenty of support with central banks. There's still plenty of support in the marketplace for a search for yield and keeping rates relatively low for now.
Okay, so if rates stay relatively low, should we expect then the rotation to remain a slow one? When you look at the performance of some of these groups next to each other, we had such big moves. If you look at equal weight versus the regular S&P 500, the market cap weight, you have another chart that shows just how big of a difference we got in terms of that performance that shifted. I mean, it seems like right now we have a lot of volatility and this factor volatility that is like week to week, where we've had some of the biggest outperformance and some of the biggest, underperformance. In this case, we obviously know the outperformance on the trailing basis has been hugely in favor of the market cap weight. So, Yoav, if there's already all this money moving into this area that now is struggling, is it the rate situation that exacerbates the money moving back, or could there be a scenario where, even if rates don't take off, investors just say, you know what, there's a momentum that's shifting here. Can it shift on its own, that momentum?
I think what happens is when you have episodes, particularly like last Monday's, it just gives investors some pause and makes them reassess perhaps where their risks are concentrated and where their portfolio risk is embedded. Obviously when rates move, that has implications not only on equity valuations but asset classes across the board. But at the same time, you have to consider or think about the fact that there's we probably peaked at $4.5 trillion of money market assets, and we're now still at $4 trillion of money market assets, which are essentially sitting on the sidelines. So eventually that money is going to have to go somewhere. Usually doesn't sustain those elevated levels. And I think we're seeing factor volatility. We're seeing some of these starts and stops, these spurts, if you will, of uncertainty really related to just the big question mark that's not only in the markets, but it just the world globally right now. So I think as we continue to get more clarity, obviously with the vaccines and the pandemic in general, we'll start to see potentially some of those moves and some of that factor volatility subside.
Yoav, one of the volatility charts that you've got here, that value versus growth factor volatility, it only has had big moves like this at a few points in history. Should this make us nervous? This is like 2008 where you saw this kind of explosive degree of rotation. Is this a coincidence? Is this time going to be different? Because last time investors were trying to move this quickly to reposition, it seems there were major headwinds coming.
Yeah, I think, obviously it's something to be aware of. And anytime you get factor volatility spike or any sort of potential rotation, you just want to be aware of it and make sure that, you defend and position yourself appropriately for that. I think it's important and a big key distinction between now and, say, even 08 or especially 2000 is the composition of the types of companies that have quote unquote been working now. The growth companies, these large tech companies, they're vastly different than what was occurring at the beginning of the century. So I think in that regard, this period is quite different than last time. If you look at the large tech companies, whether it's FANG or FAMG or what have you, those are just vastly different companies than what we had, 20 years ago. And today they're arguably some of the strongest companies in the marketplace.
So the idea here is that the rotation could be more gradual because investors are not going to flee the, by definition, best, most profitable companies in the market. Is that what you're saying here, Yoav? That even though they might, it's not like people are going to flee Apple and drive a huge sell-off if there's a fundamental kind of put in the fact that they make money and these are big profitable companies.
Yeah, I think that's an important distinction to make, and I think that's an accurate one. Obviously, the factors that are increasing the factor volatility, it's noteworthy. As you mentioned, these levels aren't sustained very often, so something to be aware of. But I think at the end of the day, market participants, investors are going to consider and think about, okay, well, what companies am I invested in, and what's the composition of that? So maybe there won't be this massive rotation, but it could be just a digestion period or a period where the specific factors aren't as impactful going forward.
Yoav, one other thing I want to put in perspective here that seems like maybe it could be still a force that hasn't played out yet is looking at flows. One of the charts that you've got here that comes from Citi analysts shows that while shorter term, some of the hedge funders have kind of shifted a little bit towards value and small caps, the long only money flows, as we know, over the last decade have been very much driven into long duration assets, S&P 500, tech, and bonds. It seems like over the last 2 months, they're kind of still doing a lot of that. They're not piling into value. They're not really looking at these rotationary aspects. The flows seem to be very much kind of business as usual. Does that mean there's another leg potentially coming, though, of people that have long-term investment goals, if that BlackRock style money goes into these trades?
Yeah, I think that chart I think is interesting because it kind of gets to the point of what, particularly last Monday was all about, and we had been seeing it throughout the week, really, that all the activity in that rotation, trade in parentheses was really done by, hedge funds or quicker money. I mean, the long-only community has not really rebalanced or reallocated, and I think that's in part because of the confidence that the investment community has in the duration and ability of these companies to persist. In one regard, the tech companies have had a great run, no doubt. The question is, does the future going forward support their ability to continue to generate substantial profits? So I think if we were to see the long-only community also participate, that would have a much greater impact as well. And I think we would see that also with, how the assets and money markets are sitting right now and where they're being used. So I think all of it, they're all pieces of the mosaic, and in conjunction kind of provide the broader picture of where the money is going after.
Okay. Well, just a couple weeks ago, BlackRock announced they've got a new small cap value ETF, ticker SVAL. So maybe they see something coming. It's done pretty well since it launched. Yoav, appreciate you joining us. Always really good perspective. Thanks a lot.
Appreciate it. Thank you.
Thank you. Yoav Sharon is portfolio manager at Driehaus.